Hello, and welcome to Portfolio Matters, Weekly Markets Checklist, week 156. And Richard is back, hurrah, from having his boat gilded. But before we get into it, he will read the disclaimer.
Thank you, Keith. Nice to be back. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Over to you, Keith.
Thank you, Richard. News this week. Well, the Fed met and it held rates at 5.25% and warned that inflation was not coming down as fast as it would hope and rates would stay higher for longer. There was no warning currently about having to raise rates, which is what the market has been concerned about, or some market participants anyway, but it did slow down the rate of QE starting in June. So currently QE is around 60 billion a month. So the Fed is selling into the market 60 billion worth of bonds from its QE holdings. In June, that will slow to 25 billion. The macro data this week was not very good, I'm afraid. So the employment cost index for the US came in higher than expected, and productivity was very poor. PCE inflation also came in hot. The good news is that the EU economy returned to growth in Q1. But the general picture from the American data was that inflation was more persistent than had been expected, and wage growth was stronger than expected. In the US, we've had results from Microsoft and Alphabet, and last night Apple, all of which beat expectations. Tesla shares, having done a segment last week on Tesla and how its revenue growth was collapsing, the Tesla announced a deal with Baidu to roll out its self-driving cars in China, and its shares shot up. Cocoa prices, we've covered in previous weeks, they've been rising very strongly on droughts in West Africa. Well, there's a strong crop in Nigeria, and cocoa prices are now falling sharply. Some charts related to the news. Well, this is Fed's balance sheet. The pace of QT will slow to 25 billion a month starting next month. And following the FOMC meeting, the markets are now expecting just one rate cut in November. But higher interest rate expectations have not fed through to tighter financial conditions in the US. So the Fed is not really succeeding in tightening financial conditions and slowing the US economy. And sadly, the recent data surprises in the US have been very poor. So the economic surprise index is fading again rapidly, but inflation has surprised to the upside. So the US economy is surprising towards stagflation. Microsoft, Alphabet, and Apple have all reported strong earnings. And elsewhere, the yen had an incredibly volatile week. So it sold off towards 160, and then it very much looks like the Bank of Japan intervened to strengthen the yen. But medium term, unless the Japan allows bond yields to rise to much higher than where they are now, then it looks like the yen will continue to weaken. Japanese interest rates are fundamentally much lower than the rest of the world, where rates are staying higher for much longer, and that's very bad for the yen. And this is cocoa prices, big drop from their recent peaks. And
I
finally,
was thinking, sorry, Keith, it's a slight aside, but as I opened my Yorkie yesterday, feeling the fact that the bar inside, the wrapper stayed the same size and the bar is much smaller than it was. I was thinking, I wonder if cocoa prices are now dropping, whether the bar inside the wrapper is going to get bigger or not.
not for a long time yet, I'm afraid. Possibly.
Yes.
And finally, this is the latest polls in the US where Trump remains ahead of Biden. Be
It's
afraid.
pretty close, isn't it?
It is, yeah. And let's see how his criminal trial develops.
Yeah.
And on to this week's economic data. Quick summary. Well, the UK is weak, but appears to have bottomed, and the same is true of the EU. In the US, the economy remains strong, but there are some signs that the rate of growth is slowing. Interesting data this week. In China, very difficult to tell, but global manufacturing cycle appears to have bottomed, but the latest PMIs show it not strengthening further. Okay, on to the UK, Richard.
Keith. So nationwide house prices index month on month. They've fallen a little bit, haven't they? But they had not enough to counteract the surge that we had in late 2023.
Yeah.
And there we have year on year, where they're actually currently neither up nor down effectively year on year, which is, I don't know. I think the other day that the interest rate rises, the effect of those on people coming out of fixed rate mortgages is still, I mean, as we've discussed previously, it's still got quite a long way to go before everybody moves up to the current interest rate.
Actually, we'll save that because we've got that chart coming up.
As we have coming up. The UK Citigroup Economic Surprise Index. It's there we are. It looks like one of those, in the 1950s sci-fi films where they sort of show an oscilloscope with the thing buzzing, the line buzzing up and down frantically. It's like one of those, doesn't it?
Or somebody having a heart attack.
Yes, that's right. UK Trueflation, actually, for the last couple of months, has been fairly steady at 3%, basically at 3%, slightly below the government reported rate of 4%.
Not low enough.
No, but at least it's stable. And UK shop price inflation dropped in April, all of the numbers dropping. An interesting article I was interested in the FT this morning about consumer spending and how it's been affected by inflation. Spending on staples, particularly meat and bread and fruit, all dropping. And
goods spending is goods inflation is not the problem. Goods inflation is coming down. It's services.
Yeah. So European debt levels are rising again. This is government debt portion of GDP. And the UK is about 100%, projected to rise to 110%. France is in a similar situation, at 110%. So basically, this is not good news for economies, in my view.
Yeah.
Rather suggests that governments are incapable of controlling their debt. Business creations in the UK were 6.1% higher in quarter one 2024 than in quarter one 2023. Small businesses are the lifeblood of an economy.
Yeah, I was actually very pleasantly surprised by this.
Yeah, that's good news, isn't it?
Yeah.
And business failures, which have been rising, hadn't they, are now down. So that is also good news. It suggests perhaps that this sort of post-COVID bump that we had in business failures is now past us. I mean, fingers crossed.
Yeah. It does look like the UK economy is bottoming.
Yeah. So we didn't have very much data this week in the UK. House prices certainly not rising, possibly falling. And the IMF is forecasting UK GDP growth of just 0.5%. I wish they put it as GDP per capita. I'd like to know what that is, because I think that's a much more relevant measure than just blanket GDP growth.
Thank you, Richard. On to the EU. So we had GDP growth numbers for the first quarter, and they were surprisingly strong, actually, at 0.3%, which in the Eurozone represents actually fairly decent performance by historic standards. And year on year, 0.54%, again, much better than expected. And when you dig down into the country level data, actually broad-based growth. Germany, which had actually been forecast to continue declining, unexpectedly grew by 0.2%. So saw growth across the Eurozone, which is rather reassuring. But when you look into the components of what made up that growth, you will see net exports and inventories were a big part of it. And that really looks to me like the US running a huge trade deficit is supporting the rest of the world. We also had preliminary flash inflation numbers for the Eurozone, and they met expectations, 0.6% for April, and that's not a great number, although it was at expectations. Year on year, inflation was flat at 2.4%. Core fell to 2.7%, but not as much as had been expected. Inflation is coming down, but more slowly than you might hope. We then had the Eurostat surveys for April, and they were generally slightly weak. So economic sentiment fell to 95.6, below expectations and slightly below March. Industrial sentiment faded again, minus 10.5, below March, below expectations. The expectations had been for it to strengthen. And you'll notice that that is actually a new low number this cycle. That's not very good. Services sentiment, again, below expectations, down on March. So from the Eurostat surveys, you get the impression that the Eurozone economy is not improving. Consumer confidence came in line with expectations, up a tiny bit on March. Inflation expectations fell, but not as much as expected. Selling price expectations also fell, but not as much as expected, but that is a decent number. Citigroup Economic Surprise Index is fading again, but remains positive. So this chart shows GDP forecasts for the US in green and the Eurozone in black. And that is an absolutely enormous gap. There is a big difference between the economic outlook for the Eurozone and the US and for their inflation outlooks. Some charts on Germany. Well, pause, take a look. The German economy is not doing well, and the fact it grew in Q1 is rather surprising. The top left chart shows the change in industrial employment, and that continues to decline. The chart top right is the employment in the rest of the economy, and it's had a little bit of bounce in towards the end of last year, but not great. And job openings continue to decline. And when we talk about China, you'll see that Chinese car exports have been exploding higher. Well, the flip side of that is the German car industry is seeing a continual fall in new orders. So it looks like there may be a structural decline in the German car industry, which has been a huge supporter of the economy for the whole post-war period. So in some way, the Eurozone has returned to growth, and surprisingly strong growth at 0.3% for the quarter. But the Eurostat surveys were generally weak. Inflation is still falling, but perhaps not as fast as we would like. The Eurozone economy is weak, but does appear to have bottomed, though there's little sign of further strengthening. On to the US, Richard.
Thanks, Keith. So US employment costs quarter on quarter up 1.2%. So what's that annualized rate of? Nearly 5%. Yeah,
that's a bad number. So Highest for best part of a year.
Yeah.
Not great.
And US labor productivity, one of the things we've remarked on is the US productivity growth, isn't it, over the last 12 months or so? And
Yeah.
suddenly that has declined. Now it's just a 1 month, a 1 quarter even indicator at the moment, but it'd be interesting to see whether it picks back up or whether something's happening in the US that's damaging labor productivity.
Yeah. This is surprisingly volatile, is what I'd say.
Yeah, this is very true, Keith. And unit labor costs quarter on quarter annualized, there we are, nearly 5%. And
Yeah,
that is not what the Fed would have wanted to have seen.
absolutely. That's a bad number.
So this is a table showing that data for April is suggesting a slowing in the US in employment tax receipts. And that suggests either unemployment is increasing or labor costs are falling, but we've seen that labor costs aren't falling. So does that suggest that employment is reducing?
Yeah. So just to explain this table, the numbers on the right are for last year, numbers on the left are for this year. And so the growth rate compares the numbers on the left with the column on the right.
Yeah.
And they are surprisingly volatile, actually. So, if you look at July 23, you're looking at 14.6% growth in employment taxes. But the latest number shows only 4.3% growth. Volatile, but, I don't think you can say they're rising anymore.
So this is just another chart shows that the increase in wage growth in Q1, which is in the private sector, which clearly is not good news for prospects of inflation.
Now, there was some commentary online that the strength of the employment cost index may be due to seasonality. Well, I downloaded the data for 2001 to 2024, and you can see the quarterly averages. And it's true, there is some seasonality, but it's very slight. I'd say 7 basis points, not very much.
So we've got an easing of labour market conditions and a rise in wage inflation. So spot the conundrum, spot the contradiction.
Yeah.
What's this one telling us, really, Keith? It's not a huge difference, is it?
So ADP is a private survey of private companies, and that's again strong. I mean, it's higher than consensus, slightly down on March, but that's the best number. When you look at over the past year, that's a strong number, and that suggests the US economy remains strong.
The challenge of job cuts is not showing us anything remarkable.
Yeah.
The JOLTS job openings is continuing. The decline is possibly slowing down, but it's just continuing a steady decline, possibly back towards the pre-COVID rate of around about 2019. We shall see. And the quits is still dropping quite quickly, and a steady decline trend, which suggests that people are continuing to slow down in how they move from one job to another.
Yeah, they're feeling more insecure.
Yeah, or maybe there are fewer jobs that they want to move to. They sort of have the same ultimate cause, really, which would be a slowing of the employment market. And the JOLTS hires rates doing the same thing.
Mm.
It's
that's low. That's a low number.
It is, isn't it? It's back to where as low as it was in 2014.
Mm.
And the JOLTS layoff discharges rates is just a flat line to all intents and purposes. So
Yeah,
it's still
but
a flat
again,
line.
that's a low number. That's lower than. So it seems that people just aren't moving jobs. There's a kind of both employers are not hiring and employees are not leaving.
Yeah. But employers are paying their staff more.
Yeah.
They remain 1.3 job offers per unemployed person.
Yeah.
Very high by historic standards, but dropping.
Yeah. There is a question about how many of these job openings are real and current.
Yeah. And this is the hiring rate in leisure and hospitality, which has dropped back down to basically sort of historically normal levels, hasn't it, Keith?
Yeah, but actually, I'd say pretty weak levels compared to pre-COVID. I mean, that suggests that the US economy, the US consumer is not spending as much in restaurants, etc., leading to a lower demand for staff.
Yeah,
Which is interesting.
Construction openings have had a massive decline.
Yeah.
This must be a reflection of what's going on in the office building.
Well,
sector.
the thing is, Richard, I'm slightly suspicious of this number because it is very volatile.
Yeah.
And, if the drop in jolts has been in part caused by 150,000 fewer construction jobs, and it bounces back next month, then the fall in jolts could be more exaggerated than it really is. But when you go on to construction spending, we've now had 3 months of falling construction spending in the US. So maybe this is correct.
Yeah. It's certainly changed its nature, hasn't it, from how it used to be, the volatility in it. Job postings, Indeed job postings are declining, fairly significant percent changes. I mean, the only problem we don't know there is we don't have a direct link between Indeed job postings and job openings.
Yeah, but I thought that the sectors were quite interesting. If you were going to say which sectors are most impacted by AI, what would you say?
Yeah, software development, information design.
Yeah, exactly.
Month-on-month PCE inflation, 0.3%, annualizing to nearly 4% year on year. Why it doesn't, so that the year on year is only at 2.7, which suggests to me that the PCE rate of inflation is increasing.
Yeah, that's true. And this was higher than expectations and up on February, so heading in the wrong direction.
And core PCE month on month, 0.3% gain, unchanged. And year on year, core PCE 2.8, which actually is less than an annualized 0.3, which is nearer 4%. So again, this rate of inflation appears to be increasing.
Yeah.
US personal income month on month, up 0.5%.
Yeah. Now, when you dig into this, it's not just wages, it's dividends as well. Now, so there is a distributional aspect of this in that dividends are mainly going to go to the rich, but you can see how the Fed's in higher interest rates feeding interest income into companies who are then paying it out to shareholders. We'll go on to this later.
Personal spending month on month, 0.8%. It's slowly increasing, isn't it? A sort of gradual increasing trend there, I would say, better than consensus expectations, and certainly quite a lot higher than the increase in personal income month on month.
Yeah, and again, this is another thing that I've been totally surprised by because we've been covering again and again the decline in US pandemic savings, which should now be almost exhausted, but still they are spending.
US construction spending month on month now in negative territory, and it's got sort of 6 to 9 months of being pretty much either flat or negative. The ISM manufacturing PMI, 49.2, so that's slightly below 50 and not particularly healthy.
No.
And ISM manufacturing new orders also sort of flatline basically at around about 50, so that doesn't suggest any growth. The ISM employment is at 48.6, but it's in a downtrend. ISM prices paid, that's a sudden jump up, isn't it?
Yeah, that's not good.
Yeah. And US factory orders month on month, looking quite healthy actually.
Yep.
And factory orders ex transport month on month, also looking moderately healthy.
Yeah, I'd agree.
The consumer confidence index is, if it's in a trend. It's a very, very long-term trend, and it's around about neutral.
Well, the thing is, Richard, that, it's hit recent lows, the lowest it's been in a couple of years.
Yeah.
Not great.
No, but it's neither is it bad, if you see what I mean. It's sort of like,
Yeah, that's
is
true.
it telling us something, or is it just,
Yeah. We need to see how that develops in the next few months.
yeah,
That's all.
I don't think so. So the Chicago PMI is pretty bad. It's just sort of plunged really back down to that late 2023 low.
Yeah. Now, this is really surprising. Now, but again, the US economy has been doing incredibly well for the whole of 2023. And you wouldn't know that from the Chicago PMI,
No,
which,
no.
so remind the Chicago PMI is business conditions in the Chicago area.
Yeah. Fed manufacturing index is flat, really. And it seems to have achieved a new baseline, which is around about -17,
Yeah.
Dallas Fed Services Index. I mean, this is a point actually, is that do these things need to be rebased? Because we know the US economy is doing well. So actually, should
Yeah.
one be rebasing where these are since COVID for whatever reason?
Yeah.
3-month moving average of the average of the regional Fed manufacturing indices is negative. That's the sort of greenish line, isn't it? Is that green, Keith?
Yeah, green.
Green one. But it has been moving up since, well, for 12 months, actually, it's been on an uptrend.
Yeah.
Average line. Case-Shiller House Price Index. Well, there's a sudden jump, isn't it? Is that spurious? Question.
Yeah, that's a big jump month on month.
Year on year, there's distinct signs of it rising, although obviously the month-on-month figure we've just seen will have an impact on that, but it's been rising for a while now. Red Book retail sales looking pretty healthy.
Yeah, again, there's no sign the US consumers slowing down.
No. The 30-year mortgage rate at 7.3%, so it's remaining at that top end level of 7% there.
Yeah, but house prices in the US are strengthening quite strongly. I mean,
Yeah.
it's mystifying.
Yeah. And the mortgage market index still flatlining.
Yeah.
As if it were dead. US initial jobless claims, pretty low. Continuing jobless claims are basically continuing that slow decline that we've had for the last 12 or 14 months.
Yeah. Now, the Psalm rule signals the start of a US recession if unemployment moves up by more than 0.5% over 12 months. And it is ticking up again. So something to watch. There's one of the things that has been surprising is how unemployment levels are ticking up, but unemployment claims for benefits are not.
So US Dallas weekly economic GDP indicator is, well, it's at 2, and it's, I mean, the funny thing about this chart is interesting when it's moving. When it's flat as it is now, it's and basically it's showing that the GDP is at 2% and has been for quite a while now, and I mean, give or take a little bit,
Yeah.
and isn't changing.
Yeah, I think this has been quite accurate, actually.
Yeah. The Atlanta Fed GDP now, it's at 3.3%, so
Yeah.
a bit above there.
That's the first estimate for Q2.
And the US Citigroup Economic Surprise Index is at 2. Last week it was at 20.
Yeah. Fading again.
And US Trueflation 2.3%. And this chart is showing that after a big spike, actually, in March, it's falling back down quite quickly.
One of the frustrations about Trueflation is every week the historic chart changes. So, last week they were reporting, inflation of 2.28%. But if you look at this chart, it would have been closer to 2.5%. Yeah.
Oh, yeah. So it's not really trueflation at all. Yeah, and you can't change your trueflation numbers, can you? They are what they are. If you start changing them, then it's no longer trueflation.
Yeah. You need to get onto their marketing department. So
yeah, it's just another crap piece of data, Keith. Like all the rest of them.
yeah.
You have to try and sort of parse your way through them.
Well, choose the data points you like, Richard. I like this one.
US multivariate core trend inflation. And it's at 2.6% in March, which suggests, I mean, it doesn't look like there's a resurgence of inflation there, does it? But some of the other things we've looked at suggest there might be. So,
well, more on that later.
And US household excess savings rate continuing. The excess savings are continuing to fall. The savings rate is now fairly level at around about 3.5% or so.
Well, the thing is, Richard, this chart from Oxford Economics says that US households still have 600 billion of excess savings. And at this rate, it's not going to be exhausted until December. Yeah. Whereas, we've been talking about this so many times, but so this is the San Francisco Fed. They reckon essentially they're already exhausted. So who's right? I mean, and reminder, previously, the San Francisco Fed thought they'd all been exhausted by Q4 last year, and then it revised them higher. So what we know is that the US consumer continues to spend. I mean, the 0.8%.
They are running down, Keith. Whoever's right, within the next 18 months, they probably will have gone.
Yeah, agreed.
So the US labor supply has been bolstered by a big rise in illegal immigration post-pandemic. I mean, you could actually say post-Biden there. I think that's been his policy.
These are absolutely enormous numbers.
I just think this is very destabilizing for any society, I think, actually.
Because this is like per annum, yeah? So that's like 2.4 million people a year, illegal immigrants. So over the course of 3 years, something like 6 million people, over 6 million people have entered the US illegally. Amazing. That's in addition to lawful immigration. Now, one of the puzzles has been how the JOLTS job opening rate has been falling, but we've seen really not much of an increase in unemployment. Well, the Beveridge curve is very flat when you have lots of job openings. And then when it gets down below, let's say 4.5%, then unemployment starts to rise. And we are approaching that point. So if job openings continue to fall, at some stage, we should see a rise in unemployment.
So this is a summary of what we've been discussing. So labour costs high, annualised rate of 4.7%, and a significant reduction in productivity there. There are various sorts of inflation measures, but they're all around about below 3%. Construction now has been negative for 3 months. The construction is looking like it's fading, which we have been suggesting it should do for a long time. ISM, the numbers I think are they chop around quite a lot, so it's hard to know. And all the jobs reports suggest that the market is either stable or possibly not the market. The employment market is either stable or possibly beginning to slow. So nothing to see here.
On to China. So we had the NBS, National Bureau of Statistics PMIs, and they were absolutely fine. April 50.4, slightly above expectations, down on March. Services actually fell quite sharply to 51.2, below expectations, below the March numbers. That meant the general disappointed at 51.7. So according to the official statistics, the Chinese economy is growing, but not strengthening. We then had the private sector Caixin manufacturing PMI, and that came in at 51.4, up on March, and shows manufacturing activity strengthening. The services should be out next week. Now, one of the flip sides of China investing vast amounts in manufacturing capacity is you can do that, but you're then surely flooding the economy with supply and prices fall. So if you look at their profits are falling. So this chart shows manufactured goods surpluses from China, the US, Japan, and Germany over the last decades. And you can see in the last 20 years, China has become the manufacturing hub of the world at the expense of the other exporting nations. And one of the side effects of the massive investments in Chinese manufacturing is look at the red line here, which is Chinese car exports. Absolutely shot up over the last 3 or 4 years. And they are going to be stealing market share from the traditional auto exporters. Everything I read says that Chinese electric vehicles are cheaper and better than those made in the West. And China now exports more to Southeast Asia than it does to the US following the Trump tariffs. But this chart's amazing. This is the poverty rate in China since 1981. The joys of communism in one chart. Now, one concern for China is that the collapse in the yen means that compared to Japan, its exchange rate has risen incredibly quickly. So that erodes its competitiveness versus Japan. And although the Chinese trade surplus is now extremely high, if this were to continue, you might fear that China would devalue the yuan to maintain its competitiveness, which would increase its trade surplus again.
Yeah.
So in summary, we don't know what's going on in China, the bottom line. We know that the property sector is very weak and that China is now investing in manufacturing. PMIs, who knows?
So interesting, Keith. I know it's a slight sort of digression, but I'm still holding my China large cap ETF, which is actually doing quite well. And
very good.
Yeah, but the reason it's doing quite well is, I guess it's fairly obvious from the charts we've just looked at, isn't it? In that Chinese manufacturing and Chinese exports are doing very well. And but what we haven't done is what China hasn't done yet is solve its problem with property market, residential property, and that is still lurking in the background somewhere.
Are higher US rates actually good for the economy? So as the Fed has raised interest rates, does that mean the US economy actually strengthens?
Right.
So over the past 2 years, the Fed has raised rates by an enormous amount, from 0% to 5.25%. And the San Francisco Fed's proxy rate, which measures real rates in the economy, has gone from a low of minus 0.4% to 6.2% now. So I was expecting, as you'll all be aware, this to kill the economy stone dead, but it hasn't. And actually, when you look at the latest data on the US economy, most of it is actually better than it was when the Fed started hiking. Now, the GDP growth depends on who you take, but the Atlanta Fed's latest estimate is 3.3%, higher than the start of hikes. The unemployment rate is unchanged. Corporate profits are higher. The S&P is higher. So at the very least, you'd say that higher rates have so far had no effect whatsoever on the US economy. And people who believe in MMT would say that higher interest rates mean that because the US has got so much debt, the government is paying a lot of interest on that debt and therefore pumping cash into the economy, and that is supporting the US economy. So higher interest rates mean the government's actually pumping more money into the economy, supporting it. And the Congressional Budget Office estimates that the US will run a deficit of 5.6% this year. Reminder, the US economy is doing incredibly well. It's currently running at about 3.3% growth annualized. Surely the deficit should be much lower than this on a cyclical basis. And the IMF has warned that next year it expects the US deficit to be an absolutely enormous 7.1%. Meanwhile, US homeowners have fixed their mortgages during the pandemic onto 30-year low interest rate mortgages. And so the rate available in the market is the black line, and we know that's shot up to 7. The light grey line is the average interest rate paid on existing mortgages, and it's barely shifted. Higher interest rates in the US have not affected the main loans that US citizens have, i.e. their mortgages, at all. So monetary policy is less effective than it was. So why higher interest rates may be positive for the US economy? The bottom line is the fiscal deficit. The US has 34.6 trillion of debt outstanding. An interest rate of 5.25% therefore pumps in $1.8 trillion of interest into the economy, or 6.5% of GDP. I should say that the actual rate will not be 5.25% because the US will have sold bonds with long maturity previously during the pandemic. And so its net interest rate will be lower than that, but it will be rising because it will be refinancing those cheap bonds it sold during post-GFC onto much higher current rates. And US consumers have 13 trillion of cash, but only 5 trillion of short-term debt, which is linked to interest rates. And David Einhorn, the US hedge fund manager, estimates that households are therefore benefiting from an extra 400 billion a year thanks to higher interest rates. So higher interest rates are not sucking money out of people's pockets. They're putting money into people's pockets. But when you look at real interest income, it's actually down from pre-pandemic levels. Nominal interest income has shot right up. And net interest income has actually fallen quite substantially. So it seems that higher rates have not had the effect of pumping money into citizens' pockets in real terms. And when you look at the net interest expense of US corporations, it's not trending higher, but it's not falling either. So there's little evidence that sharp rise in interest rates has led to a rise in corporate earnings. Then, if we now turn to the UK, well, in September 23, UK government debt outstanding was £2.65 trillion. And if they paid 5% interest on that, that would inject 133 billion into the economy, or 4.9% of GDP. The big difference between the UK and the US is that UK mortgage holders have, on average, 2 to 5 year mortgages, and those are being refinanced at higher rates. UK homeowners are feeling the effects of higher rates. So this is the average interest rate on outstanding UK mortgages, and you see it's absolutely having an effect. So reminder how higher interest rates are meant to impact the economy. Higher interest rates should reduce spending. Consumers and companies suffer from higher interest costs on their existing debts, forcing them to reduce spending on other items, and also it increases the cost of any investment or large purchase that requires debt financing. So reducing demand for investment and large purchases. Construction activity is particularly affected because buying a new house requires taking on an awful lot of debt. Now, it is not working in the US because both consumers and companies are locked in long-term debt and low interest rates, and therefore, frankly, are not really feeling the impact of the rise in the Fed funds rate. Instead, they've been net beneficiaries of higher interest income on their cash holdings. So the bottom line is there's a timing problem between higher monetary policy now and when consumers and businesses start to feel it. In the UK, home owners are certainly feeling the pinch. In the US, they won't feel the pinch until they need to remortgage in 30 years' time. For US businesses, they'll start to feel it when they refinance their existing debts over the coming 5 years. So this is the schedule for US corporate debt refinancing. You'll see it begins to impact them really over the next 4 or 5 years. So monetary policy, the transmission mechanism is slow. But as we've talked about previously, there's a big distributional effect in higher US rates. Small businesses, which rely on bank loan funding, are absolutely feeling the impact. Lower income consumers in the US with personal debts, they're also feeling it. And you can see that from the rising delinquency rates, particularly on credit cards, but also on auto loans. And US businesses with long-term investment requirements will be feeling the higher costs associated with large future projects. So the bottom line is that monetary policy, I personally don't think that higher rates are stimulative, but the transmission mechanism is much slower in the US than it is in the UK and the Eurozone. And as a result, the US economy is doing absolutely fine, and the UK and the Eurozone are not. So in summary, I'm not convinced that higher interest rates are positive. I just think that they're slow to react because of changes in the way that both consumers and businesses borrow. They've locked in long-term low interest rates. So they're not feeling the effect of higher interest rates for now. And in the US, the higher interest rates have this strongly asymmetric effect on the economy. So poor people, low-paid workers in particular, have debts while the rich have assets. And so they are feeling the impact of higher rates, whereas the rich are not. So in my view, monetary policy works with long and variable lags. Your view, Richard?
Yeah, I agree, Keith. I think I actually think central banks have been caught out by this, because I think in the 1970s, there were the number of, apart from the fact that there was much less debt in the economies, much less of that debt was fixed rate. And there was just a sort of generalized assumption that what worked then will work now for the same reasons. And it doesn't work because the nature of the debt has changed. So it's a much more. What's also interesting to note, actually, is that why has the Federal Reserve slowed down its rate of QT? And you looked at that chart of the financial conditions index that we showed earlier. The financial conditions aren't tightening, and slowing down the rate of QT lends force to the non-tightening financial conditions. And so it's there's this weird contradiction in their behavior, isn't there? We're going to keep interest rates high, which tightens financial conditions, and we're going to slow down the rate of QT, which loosens financial conditions. So what are they actually trying to do? And are they trying to be sort of political with a small p, in that they don't want to raise interest rates, but they think the economy is going to slow if they leave them as they are, so they reduce the rate of QT? And I mean, the other point, well, many points, but the point that the governments are putting interest income into the economy when they are, in fact, net debtors and increasing their debtor status is spurious, because effectively what's happening is that it's not spurious, but effectively what's happening is that money is going in via additional government borrowing.
Yes.
And the additional government borrowing at the level it's at now is bad for future economic performance and future financial stability.
Yeah.
I mean, the last point I guess I've made is that interest rates of 0% or 0.5%, certainly, I think in the UK, well, I don't know. I think you have to treat Japan as a separate case here, and I don't know about that, but it does lead to poor economic decision making, and I think one of the reasons we've got such low productivity in the UK is that there has been the interest rate, having to pay interest on money you borrow. It very much concentrates the mind on what your return on that capital is going to, or that borrowing is going to be. If you don't have to pay interest on it, you don't have to concentrate the mind. It's a free lunch.
Yeah.
I think that has led sort of generically to inefficiency within the UK economy and probably within the US and the European economies as well. That'll take a long time to come out because that'll come out over the duration of the debt.
Well,
so. And my final comment is that historically, interest rates have never been as low as they were over that period. And I saw and I see no reason why they should have to revert to those low levels. And I suspect they never will personally, because I think people understand that it wasn't a sensible thing to have done. So that's sort of where I am on it.
Well, I disagree with you on that, Richard, because I think that the very high debt levels in absolute terms, so the level out of the outstanding debt, means that simply interest rates need to come down or they're unaffordable. And the US in particular, I think, has got itself in a big fix because it is now running this enormous deficit when the economy is doing fine. Now, we talked previously, I think 2 weeks ago, about Joe Biden's suggested 2025 budget and raising corporate taxes and raising personal taxes. This is unsustainable. And some stage he's going to need to tighten, and that's going to slow the economy. So at some stage, he can't continue running this huge fiscal deficit. And when we talk about where monetary policy, I mean, the transmission mechanism is very slow. In order to slow the economy, they just need to start spending a bit less money, or the government does.
Yeah. Well, I think you may be right, and I guess there's a lot of moving parts, many of which are moving very slowly, but which are moving. So the US global hegemony, which it had since the fall of the Berlin Wall, is fading away slowly. Its abuse of its financial power and its reserve currency is causing the non-Western world to move away from using the dollar as a reserve currency. That is happening, and it's going to continue to happen. And it's a no-brainer, isn't it? Of course they are. I mean, when we saw the chart of China effectively taking the world on in car exports. So the US is not going to be able to issue it's not going to be able to issue the debt it wants to in the long term if this trend continues. And if it reduces interest rates, again, I'm not talking about tomorrow, but as a sort of a generality in this environment where its position as the world reserve currency is slowly weakening, if it reduces interest rates, it trashes its currency.
Yeah.
And if it trashes its currency, it causes itself all other sorts of problems. So it's just like it's a multi-dimensional moving picture and or machine. And so I think that it is very difficult to know actually how this is going to play out over the next
No, I agree.
10 to 20 years. And I think it's very difficult to know where we are in that process right now.
Yeah. Well, expect volatility.
Yeah, and expect strange things to happen.
Yeah, I agree. Yeah.
But who knows what they might be.
Yeah, I agree. Okay, thank you, Richard.
And if everybody isn't completely confused by now, they ought to be.
Well, I am.
Yeah, me too.
Right.
Okay, so having a look now at the UK housing market, back to the mundane. So UK house price up 20% since January 2020. And they've only really, they sort of flatlined, roughly speaking, over the last 18 months or so.
Yeah, as interest rates have shot up.
Yeah. As you would expect, unlike what's happened in the US. So in real terms, however, they are well down since the GFC peak of 300,000. That's interesting, isn't it?
I was surprised by that.
Yeah. House prices as a multiple of average earnings, however, which obviously is a measure of affordability, is at a 150-year high, which is, and rising quite sharply.
Yeah. Not good for the new generation, frankly.
No, not at all. So we had a fall in house prices in the latter half of the 19th century, which was a result of homes being built, smaller and cheaper homes being built, and rising incomes. So we can't have smaller and cheaper houses being built now because we've probably reached the sort of the limit of small size, I would guess. We have got rising incomes. Thereby hangs a tail. I could talk about that for a while if you want me to. And more homes aren't, well, the homes are being built, but not enough homes are being built in the UK to meet the demand. And that, of course, is putting a huge pressure on pricing. In the 50 years to 1918, the mortgage business hadn't really been established, had it? The cooperatives and the friendly societies, as they were actually put together to try and enable people to buy houses, but they were nascent, and we hadn't really reached the sort of level of financial sophistication that we have had now, probably for the last 50 years or so. So the government has this much vaunted target of 300,000 houses per year, which has failed to meet. I'm not quite sure when it's set, in inverted commas, that target, but the number's been bandied around for decades, it feels to me. And we don't do it. And actually 300,000 now is nowhere near enough to take the pressure out of this issue. That's interesting. So this is the lack of housing capacity over the last 60 years is attributable to falling construction by local authorities, partially offset by housing association activities. And that was partly doing the Thatcher government, wasn't it?
It was, yeah. When council tenants could buy their own homes, then that removes any incentive for local councils to build homes.
Yeah, and I think I think legislation must have changed and moved the right to build this housing from local authorities to housing associations. And I don't know that local authorities have the ability to build housing now, do they? I'm not sure whether they don't do it because they can't get the money, or they don't do it because they're not allowed to.
I think there is still some going on, but it's really not much.
Yeah.
So presumably they can, but they have little incentive to.
Yeah. So London's housing most expensive at 12 times earnings, and Scottish housing is the cheapest at 5.5 times earnings. Got to be careful. Actually, is that actually a pejorative statement against Scots people? I'm sorry. I was planning on going up to Scotland. I may not cross the border now for fear of being arrested.
Well, the thing is, Richard, I think they have suffered much less net immigration than we have, amongst other things.
Yes. So Bank of England says, and the Bank of England is usually right on these things, as we know, the rise in house prices between 1985 and 1918 has primarily been caused by falling interest rates.
So you would expect a massive rise in interest rates to cause a fall in house prices.
Yeah.
And it's barely done so.
And now London first-time buyers are paying 66% of their take-home pay on their mortgage.
This is absolutely shocking number. I mean, I really don't see how you can do that. for a sustained period.
So we run into all sorts of issues here, don't we? Like we run into the sort of financialization of the economy.
Mm.
And my question is, where is all this government debt, this 110 or 100% or whatever, whatever, plus all this off-balance sheet stuff? Where has it gone? And across the Western world, where has it all gone? And it has gone into huge distortions in the employment market, in my view, so that there's a sector of the economy has effectively succeeded in capturing, in a general sense, in capturing this funding, government funding, which is the financial sector. And so the financial sector and those who service the financial sector have super wages.
Yeah.
And everywhere, all the other sectors have suffered, and that forces up that creates effectively a property price inflation that the super wage earners are able to afford, but nobody else. But it pushes up prices everywhere for all earners, including those who aren't super wage earners. And consequence of that is this property price inflation forces out the non-financial services affiliated population from the property market. And I sort of think that's probably what's happened. And then you combine that with the massive tax increases that we've had, which effectively is everybody paying for the appropriation by the financial services sector of all of this extra debt that's going into the economy. And of course, looking at this, you get first-time buyers now pay 66% of their take-home pay, but their take-home pay has dropped dramatically because we're now paying a highest rate of tax across the board since the end of the Second World War. So there's a huge distortion in the economy, which I think has been created by the vast quantities of public sector debt. That is actually my sense of what's gone wrong with the economy over the last 50 years. How do you fix it? I think it can be fixed, but I think it's very difficult. So the UK average first-time buyer mortgage payments percentage of take-home pay is now 40%. And a photograph of my house, Keith.
Well, actually, I thought this is absolutely typical. So this is I just went on Rightmove and looked at a terrace house in my area because I know the price is ridiculous, but I thought this was a great example of the estate agent's art. So one of these two houses is for sale. You have to guess which one. I would bet you it's the one on the left, but they're making it, giving you a photo of the one on the right, which looks in better condition.
Why does the one on the right look better? Because it does, doesn't it? But what is it that looks?
Well,
I guess
yeah, that's true actually.
But it does. You're quite right. It does look nicer.
Yeah.
1.4 million. Yeah. £73,000 a year.
Yeah. So what I did was I went on to Money Saving Expert and I looked at what mortgage you'd need to buy this place. So 25% deposit, that's 350 grand. Mortgage, 1.05 million. Monthly mortgage payments on a repayment mortgage, £6,000 a month. And that is to buy a 3-bedroom terrace house in need of work in East Finchley. How does that work? I just don't, it's mystifying me.
Well,
I just don't understand it.
It doesn't work, does it? I mean, that's the problem. I mean, it fundamentally, for the economy and for the citizens of the UK, citizens of London in this case, it doesn't work.
Yeah.
And that's the problem.
Yeah. I'm mystified.
Yeah. This is a number of fixed rate mortgages coming up for renewal.
This quarter, we'll see the last of the less than 2% mortgages being refinanced. But every month that the interest rates remain at 5.25%, we are tightening financial conditions in this country.
Yeah.
So that brings me on to quiz of the week, Richard.
Okay.
And it's rather a depressing quiz of the week for me because the question is, how much is my old house in Kiver Road, N19 worth? Okay, Now, to give you some background for this, it's on just behind the Holloway Road in London, not a great area, and we sold it for 330 grand back in 2003 because we'd had our first child, and frankly, the neighbours were, playing music at all hours of the night. It was a really rubbish area. We struggled to sell it because people would come and then they'd wander around, have a look at the area, be told there'd been a murder in the previous local park last year and a shooting in the park in front of us, and then walk away. So it took us a long time to sell this house. 330 grand in 2003, 20 years ago. How much is it worth now?
1.2 million.
Very good, actually. So 3-bedroom, and the last price on the house and road, this is like 2023, was 1.16. It remains. It's still not a good area of London.
You
That's
should have.
shocking.
It's extraordinary, isn't it? Just the concept of having to save up to buy a house for 1.2 million or I mean, it's just extraordinary.
Yeah.
The first house I ever bought when I first got married cost £28,000. It was a 2-bed semi.
Wow. God, that ages you, Richard. Was that in 1912?
No, it was in Cardiff, Keith.
A time warp of a different kind. And onto inflation watch. So the only news this week was the EU flash inflation numbers for April showed that CPI was flat at 2.4%. Core CPI continued to fall at 2.7%. The FOMC met and kept interest rates unchanged. They next meet in June. Now, the good news is multivariate core trend inflation in the US fell to 2.6% in March, and it attempts to measure inflation persistence. And the fact it is fading is a reassuring sign. Crucially, multivariate core services inflation also fell. Now, we've talked in some length in preceding weeks about how car insurance has contributed an enormous 0.8% to total US CPI inflation of 3.8% over the past year. So car insurance prices are up around 22% year on year. But the good news is Goldman are forecasting that it will slow from here. Take a look at the chart. So car insurance is causing inflation to be persistent. And monetary policy is having no effect on that whatsoever, but it should slow. Trimmed mean inflation is also falling. Now, this chart shows that the persistence of inflation in the US is due to lagged effects. The mid blue line is core PCE inflation, excluding healthcare, rent, and other regulated prices. Now, regulated prices are only now catching up with the inflation that's happened over the past couple of years. So when most of these prices are subject to annual review, and they increase in line with inflation experienced over the previous year. So there's a lagging effect. Now, if you exclude all those, the regulated prices, then core inflation really is coming down. So in some way, the market is currently concerned about resurgent inflation. But when you look at the multivariate core and inflation excluding regulated and lagging components, then it's coming down. Now, the reality is those lagging components are going to keep inflation high over the coming months, and they're totally unaffected by monetary policy. As a result, monetary policy will remain high. But over time, those effects should peter out and inflation should resume its fall. Now, quickly, we're coming into May. Should you sell in May and go away? Now, the old market wisdom is that you should sell in May and then buy back after Labor Day in the US. And the black line is the performance of the S&P 500 on average between 1990 and 2019. And you'll see that really it doesn't do much over the summer. But there is a big difference between the performance of the S&P 500 during bull markets, during the average year, and during bear markets. In bear markets, then the May to October period is poor. In bull markets, and frankly, we seem to be in a bull market, then the S&P 500 continues trending up throughout the summer, and you don't want to be out of the market. And if you look at the returns of the S&P 500, then really selling in May and going away only really works in bear markets, although returns are lower on average than in the November to April period. But this is an effect that seems to be fading. So the grey line is the rolling 10-year performance of the S&P 500 in the 6 months, November to April. And the black line is its performance between May and October. And you'll see the two lines have been converging. So the seasonality in the S&P 500 also appears to be dissipating. The underlying cause of why performance of the market may be weaker during the summer months is that investor sentiment bottoms during the summer, and the economic surprise index also shows this strange seasonal pattern, falling in the summer and strengthening in the winter. This chart shows credit spreads, and if we exclude the financial crisis, you're looking at the blue line, and they show the credit spreads tend to tighten in the summer. So bottom line, sell in May and go away is only good advice in a bear market, and we don't appear to be in one. So currently, if you believe history, you shouldn't sell in May and go away this time. And on to recession watch. Now, this is implied oil demand in the US, and it is weakening. Is that a sign that the US economy is slowing finally? So this chart shows that the leading indices have been forecasting a recession for a very long time now, but the light grey line is US GDP, which has been strengthening. Will the two lines finally converge? Generally, they always do eventually. So either we've had a false recession signal for the first time in history, or the US economy will finally start to slow. I thought this chart was absolutely amazing. This is the number of US small businesses that did not pay their rent in full and in time in April, and it rose to a high of 43% this year. But I was struck by just how high it is normally. 30%, minimum 30% of businesses don't pay their rent on time, presumably because of cash flow issues. And in California, the unemployment rate has been rising quite rapidly and is now at 5.3%. Now, when we're looking at job openings earlier, you saw that the software developers had the biggest fall in job openings, and tech is concentrated in California. That may be why Californian unemployment is rising faster than the rest of the country. Now, normally the two are well correlated, and you could argue that California leads the rest of the US, in which case we should start to see unemployment rising. And the cyclical economy has slowed. In Q1, it grew at only 0.1%. Will it fall further from here? Bankruptcy filings are rising, so the dark blue line is inverted, left-hand scale, new bankruptcy cases, and there is a decent correlation between bankruptcy cases and GDP growth. But currently, bankruptcy cases are rising and the economy is growing just fine. And we know the S&P 500 is doing well, but it's only responsible for around 18% of total employment in the US. Small and medium businesses are not doing so well, and they are the rest, or most of the rest. So, will their difficulties now start to slow the US economy? But, and this is just mystifying to me, US home buyer housing payments are up 12.6% year on year. So that is the median mortgage payment on the median house. And rising interest rates have increased this enormously over the last couple of years. But US house prices are not falling. In fact, we've shown you the February number, they're rising sharply. How does that work? Real disposable incomes in the US have been falling for the last decade. I suspect in part as a function of the increase in rent. So in 2023, only 35% of commercial mortgage-backed securities for offices were paid off in full, the lowest on record. A lot of office loans which are underwater will need to be refinanced, but so far that is not causing any wider systemic problems in the financial system. But I thought this was really interesting. So this is the latest credit managers index, and it's showing that there was a sharp drop in credit applications that were approved in April. So credit conditions appear to be tightening. And when we look, this is our own credit impulse calculation for the US, and it's showing that the credit impulse remains strongly negative, but it has bottomed. So in summary, the US economy has been growing strongly, but there are increasing signs that it is beginning to slow. Onto soft landing watch. Well, the CHIPS and the IRA Act, who's getting the money? It's the big companies. And we've talked previously about the distributional effects of Biden's economic policies, which are to run a huge fiscal deficit and also high interest rates. Well, this is further evidence that the beneficiaries are the big companies, and the people who suffer are the small businesses who don't get these enormous handouts from the CHIPS Act. Now, Andreas Steno-Larsen is forecasting that the ISM manufacturing PMIs will continue to strengthen in the coming months, and that should be good for the US economy. But in April, they weakened slightly. And one of the reasons we might expect the manufacturing sector to strengthen is that inventories are low. And at some stage, businesses and retailers are going to have to restock, and that means placing new orders with manufacturers. Very bullish for the manufacturing sector. So the bottom line is the US economy remains very strong with little sign of an imminent recession. and onto other charts. Well, we've talked previously about how the EV transition appears to be slowing. But when you look at the percentage of cars sold in 2023 that were EV in some form, so either a full battery electric vehicle or a hybrid, then the numbers can be really big. In Norway, 93% of cars were either battery or EV. Sweden, 60%. In China, almost 40%. Amazing. So it's easy to get pessimistic about the electric vehicle transition, but in some countries at least, it's already happened, and it's happening quickly in the markets that really matter, such as China. This is Moore's law, which states that the number of transistors per microprocessor should double every 18 months, and it's just kept going despite all the forecasts that it eventually must come to an end. Well, so far, and we're talking for 50 years now, it's held. This is a rather depressing chart. This is the number of US men under 30 who have never had sex. And in 2008, it was 8%. It's now an astonishing 27%. So this has to be really bad for the US demographics. 27% of heterosexual males have never had sex by the age of 30. This is a generation that's increasingly isolated and solitary. And another depressing chart is, this is the North Atlantic temperature anomaly, and it is really frightening. So the blue line is the average 2013 to 2023, so not even the average of 30 years ago, but the average over the past 10 years. The red line is 2024. We're much warmer than average, much warmer than last year. There's a lot of excess energy building up in the Atlantic, and that could translate into a terrible hurricane season at some stage. Last year, it wasn't so bad, but there's a lot of excess energy building up. And after that, you need some good news. And this is Voyager 1, which you may remember was launched way back in September 1977. Sadly, some of us remember that. And it's now been in space for 46 years. And it is 15 billion miles from Earth, having passed Pluto 11 years ago. But it is still communicating with NASA. And it then stopped working last November. And the good news is that NASA worked out that the reason it was malfunctioning was due to a single chip. And they have managed to reprogram the satellite to get around this malfunctioning chip, despite the fact that signals from Earth take 22.5 hours to reach Voyager now. So Voyager is, for now, has resumed its scientific studies on the nature of cosmic rays and magnetic fields in deep space, and it hopefully will continue working until 2036, when it will pass beyond the range of communications with Earth. So it's currently 15 billion miles away and still communicating. Amazing. And on to equities. Well, the world index had a decent week, up 0.8%, up 4.8% on the year. The all share is outperforming. My God, is up 1.3% on the week, up 5.1% year to date. All these numbers are pre the open on Friday. The Euro stocks was up 0.2%, up 5% on the year. The S&P 500 up 0.3%, up 6.2% on the year. The NASDAQ had a bounce after big tech earnings, up 1.5%, up 5.5% on the year. The Russell 2000 is back above 2000, having had a very good week, up 1.8% on the week, but it is down year to date. Hang Seng had an amazing week, up 4.5% this week and is up 8.4% year to date. Topics, despite the strengthening yen, was up 1.6%, up 15% year to date. Bitcoin, its recent strength has faded, falling 7.5% on the week, still up 40% on the year. Sterling, decent week, up 0.4%, down 1.24% year to date. Euro, flat on the week, down almost 3% year to date. The dollar index was pretty much unchanged, up 4.3% year to date. VIX fell again, 14.7. Expected volatility remains very low. Some charts related to equities. Well, this shows the problem for the S&P 500. So when you look at earnings expectations for the Mag 7, they have been rising very strongly over the past year. Earnings expectations for the other 493 have been going nowhere, been falling. Actually, they've fallen over, what was that, 15-20% over the past year. The broad mass of equities in the US, their earnings are not doing well. The market is being supported by very strong tech earnings. And the strength of tech earnings means that the US market is increasingly concentrated. The percentage of the S&P 500, which is the top 10, has hit a new high. Onto commodities. So a quick summary, energy had a bad week. Oil fell sharply as concerns about disruption from conflict in the Middle East faded. And most importantly, the catalyst was a big inventory build in the US. Industrial metals had a poor week as some of the recent strength faded. Iron rose sharply, however. Precious metals also had a poor week as some of the recent strength faded. Platinum bucked the trend and rose. Okay, on to energy. So this is Brent, which had a terrible week, down 6.4% on the week. Still up 8.6% year to date. WTI, similar, down 5.8% on the week, but up 10% on the year. That's good news for inflation. Now, here is part of the cause of the sell-off in oil. We had a big inventory build on the week, although year to date, the build is really not very much at all. US oil production is stable at 13.1 million barrels a day, but that is below the rate at which it started the year. The EIA is expecting that US oil production will grow over the course of the year, but so far it has not done. The Baker Hughes rig count fell by 5. Now, I showed you a chart earlier of US oil demand, which is falling. Well, this is gasoline demand. And you can see it's never recovered to its pre-pandemic levels, and it has been falling over the last few weeks, but it's volatile. European natural gas futures were barely changed over the past week, down 7.4% on the year. UK natural gas futures fell by 2%. US natural gas futures are now at $2 per million BTU. And last week, we reported them at 1.6. Now, Trading Economics have revised their entire data series, which is frustrating. So this is the chart they're currently showing. And you can see last week we were reporting a price of 1.6. That is, we should be down here. And that is nowhere on this chart, apart from a brief tick down in February. This is the chart they were showing last week. This is this week. The whole shape of the chart over the past month has changed. Very frustrating. Let's hope that the current chart is right. This is the coal price. Coal leapt 9% and is now up on the year. Uranium price rose 6.6% on the week. Is the correction over? Is uranium going to start rising again? And onto industrial metals. It was generally a poor week. After a very strong couple of months in March and April, aluminium faded again, down 2.2%, still up 6.1% year to date. Cobalt, unchanged, down 4.5% year to date. Copper, is that noise or has copper peaked? Down 2% on the week, up 16% year to date. Chromium unchanged, down 3.7% on the year to date. Iron ore rose sharply, up almost 8% on the week, and trading economics ascribe that to fears over mine supply coming out of Australia this year, combined with strong Chinese demand. Pause, have a read. Lithium going nowhere, up 14.5% year to date. Neodymium going nowhere, down almost 12% year to date, but appears to have bottomed. Nickel, after a strong run, is fading again. Tin, after an enormous spike, this share price, the price is dropping quite rapidly, but it's still up 19% year to date. Ferrovanadium going nowhere. Zinc actually holding its recent highs. Onto precious metals. Gold, having reached $2,400 an ounce, is fading, down 1.7% on the week, but still up 12% year to date. Silver is more volatile than gold, down 5% on the week, but still up 9% year to date. Platinum bucked the trend, up 3.5% on the week, flat on the year. Rhodium going nowhere, dead as a dodo, but up year to date. Palladium drifting off again, down almost 6% on the week, down 22% year to date, although its starting price for the year was flattered by this big rise in December. And onto rates, well, very depressing. So the bad numbers coming out of the US showing that inflation remains persistent has led to big rises in the yield curve. So UK bond prices have risen back towards their highs of last year. Terrible for me. And the yield curve is almost back to where it was 6 months ago. In the US, rates, 5-year rates, are actually higher than they were 6 months ago. And that's all been caused by rising real yields as opposed to rising inflation expectations. Now, Callum Thomas has an inflation model, and he's forecasting that inflation in the medium term be rising again, and therefore 10-year Treasury yields will remain higher for longer. So we've entered a new phase of higher inflation. I hope he's wrong, because that would be absolutely terrible for me. So this is UK 2-year, which remains very high at 4.4%. So not anticipating many interest rate cuts in the UK. This is the UK 10-year, astonishingly high at 4.3%. Reminder, the term premium estimate for the UK is negative. And the market is therefore expecting UK interest rates to remain at an average of 4.3% over the next 10 years. I think that's too high. The 30-year, amazing, 4.8%. Very bad for me. This is the US 10-year. And has it stopped rising? Is it a peaking? I hope so. If the US economy does indeed start to slow, then bond yields should fall as interest rate cuts come into the picture. This is German 10-year, also appears to have peaked for now. Italian going nowhere, Greek going nowhere. So concluding comments. Well, the Fed kept rates unchanged this week. They next meet in June. They warned that inflation had not fallen as much as they had hoped and that therefore rates would have to stay higher for longer. The US economy remains strong, but I think you can see from the JOLTS data and all the PMIs and massive data actually that the US economy does appear to be slowly slowing. Lower income workers are certainly struggling. So we're expecting, we've been saying this forever now, that the US economy should slow in the coming quarters. Non-farm payrolls are out today and expected to show that the US economy continues to create jobs. Now, I'm afraid that Richard has had to go because he's got to go and polish his golden boat. So you've only got me and I'm reporting, and this is the most depressing section of the weekly. I'm having an absolutely terrible year. I've got this wrong. I bet big that rising US interest rates would cause the economy to slow, and that would bring bond yields and interest rates down. And it just hasn't happened. I'm getting killed, down 12% on the year. Meanwhile, everything else is going up, so I'm really not looking very clever. I still believe that the UK economy can't support these high interest rates, and therefore I'm sticking with it. Now, short term, not looking very clever, and I'm well aware that if I am wrong on this, and I could well be wrong on this, then at some stage I'm going to have to bite the bullet and admit I'm wrong and buy equities. But I don't think that time is yet. Now, my strategy is to buy equities when there is blood on the streets and there's been a market crash. Now, in my career, I have seen the Asian crisis of 96, the Russian crisis of 98, the dot-com bust of 2000, the great financial crisis, the market slowdown in 2015, 2016, and the pandemic of 2020. So there were plenty of opportunities to buy when the market has fallen sharply. And I'm going to stick to my strategy, which means looking a bit of an idiot for, when the market's going up and I'm losing money. So expect more of the same for the foreseeable future, sadly. Okay, that's it. Thank you all very much for watching. I hope you're doing better than me. I'm sure you are, frankly. It was great to have Richard back. Hopefully, normal service will resume next week when his boat comes out of the water. In the meantime, please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.